Right, let's make a start. Good morning, good afternoon, good evening, everyone. Thank you so much for joining us from around the world. Welcome to today's webinar on AI-Augmented Underwriting, Balancing Benefits and Risks. My name is John Ng. I'm your moderator for this session. For your information, this is the first episode of the IAA Data Analytics webinar series, so please stay tuned for future episodes. Before we begin, I'd like to go over a few housekeeping items. Ali, if you could flick to the next slide, please, or Nancy.
You should be seeing it, John.
Yes, I can see it now. Thank you so much, Lee. This webinar is being recorded. A YouTube recording along with the presentation will be made available on the IAA website within the next day or so. They can be found where the paper has been posted under publications and papers on the IAA website. We also welcome questions. Verbal capabilities have been turned off. However, questions or comments can be submitted by clicking on the Q&A icon at the bottom of your screen. All questions, I would say we try to answer as many questions as we can during the Q&A sessions at the end of the presentations. You could expect the presentation to last roughly around 45 minutes with about 10 to 15 minutes for Q&A. And then next slide on disclaimer. So any views here expressed are solely of those of the authors and presenters. And now it's my pleasure to introduce our speaker, Lee Sakin, a Regional Chief Analytics Officer at Munich Re. Lee has around 20 years of experience in actuarial, AI, data analytics, research, and consulting roles at primary insurers, reinsurers, and independent actuarial consulting. As Regional Chief Analytics Officer, Lee leads Munich Re's regional AI analytics team located in Singapore, covering life and health across APAC, Middle East, and Africa. His team combines cutting-edge AI and machine learning modeling with deep domain knowledge to develop data and AI-driven digital solutions that enhances insurance sales, customer experience, operational efficiency by transforming underwriting and claims processes. Without further ado, over to you, Lee.
John, thank you very much for kindly moderating for us. Good morning, good evening, wherever you may be joining from. Really pleased to be given the session, and thanks to John and the IA for this inaugural slot of the data analytics series. I'll be covering AI augmented underwriting and an AI perspective, and I think it's quite timely that AI is being utilized in the underwriting and other processes, and there are very real opportunities and roles that actuaries can play to ensure that the industry reaps the benefits while managing the risks. So by way of agenda, with us. Okay to proceed, John?
Yes, go
please.
ahead.
Perfect. Thanks for the confirmation. So yes, as I was saying, I think important to just call out some context on traditional AI, machine learning predictor models versus GenAI, and the reason being that the potential for automated decisioning and the risks associated with automated predictions and decisions are quite different to recommendations and human in the loop. And I think it's a very important nuance for actuaries to think about in the role you play managing risks around AI solutions. There's a lot of talk about GenAI at the moment, but the risks are quite different if you have a human in the loop versus automated decisioning. And then I'll sketch the roadmap for augmented underwriting. And I would also like to tease the audience with the concept of actuarial control cycle 2.0. We're all well schooled in the 1.0, but what comes next with machine learning in terms of a control cycle? And that I mean for the insurer generically, but later on I will come back to it in the context of a specific AI model or specific solution. And then I think most importantly for today is to focus on a case study. I'd like to show you a few learnings and observations from a real life deployment, because we have a lot of discussion around POCs, sandbox environments, and those don't yield business value. And I think as actuaries, we want to deliver value to our stakeholders, but that can only happen in implementation. So you'll read a lot of the articles from many consultancies currently talking about have we really lived up to the expectations of AI, and those can only really come through production and deployments. So I'll show you some real life results there in production, and then I would like to spend some time on the role of the actuary, in particular this notion of AI risk implications, sign-offs that actuaries may have to fulfill in companies, and linked with that is professionalism. And then I think quite important, topics around production. I will kind of wrap up the case study, considerations for really deploying things sustainably in production. Those are not yet well understood by many that are still focused on the development POC phase. And finally, to conclude, a vision for the future of underwriting and how actuaries can optimize a balance between automation and profitability. And those are often trade-offs to make. So without further ado, just to contextualize GenAI and traditional.
Cross.
Apologies for that interruption. Okay. Right. So I think just to kind of summarize that point, the nuance of GenAI, right, is really a focus towards unstructured external data, which we've not been able to tap into before, looking at the World Wide Web of data, external published books, articles. So that's the move in terms of GenAI enablement. But traditional AI has focused on structured data, usually internal data of insurance companies, with some exceptions of external data, especially in the US. So that's just one nuance to be aware of. And one thing to call out is that traditional AI is really better suited for automated decisioning. And GenAI at this point is really focused on assistance to human experts, right? So that is a nuance which has pretty big implications for the risks that result from error or mistakes. But the human's still making the final decision. So for actuaries, you need to consider that the risk implication model error is different when having automated decisioning versus recommendation or assistance. So that is just the nuance. Traditional AI, you need to look at the use case, the nature, the risk materiality. Some use cases are high risk, and you will see this in the EU AI regulation. The risk category is called out. But just practically as actuaries, you need to understand the materiality of a model error for your stakeholders, your clients, et cetera, the end customer. What does it mean when a model has a false positive error, for example? For some use cases, it's actually very negligible risk. And for others, it's a material risk. And we'll talk about that later on. For many of the use cases like augmented underwriting, I mean, deep domain knowledge is critical to understand the data, the process in which you'll be deploying the solution, and so on. And actuaries have a lot of domain knowledge, so we can play a role there. Also, modern technology is cloud infrastructure, and finally, model risk management in production. Then on GenAI, as said, really great potential to boost productivity and accuracy, but there are still a lot of open topics, like explainability, hallucinations, evaluation of accuracy, and so on. So this is an emerging area of research, whereas a lot of those topics, like explainability and bias and fairness, we have methods to deal with that for traditional AI. So the notion of a black box for a predictive machine learning model is to augmented underwriting and an actuarial control cycle to 0 would know about where most insurers are at. Historically, they had paper-based application forms, and this is what we call underwriting 1.0. Underwriting 2.0 is really data and AI-driven, using modern cloud infrastructure for the first time to leverage the data out of rule engines, back office systems of insurers. Essentially, steps 3 to 5 here is really the augmented underwriting, what is new, where data, AI, advanced analytics are being used to augment the existing underwriting process. So there are a variety of ways in which we can do that, but essentially it draws off traditional insurance data in general, rule engine, which a lot of actuaries are not yet familiar with working with. Auto-writing engine data, really vast, rich, complex data, and also linking with back office data from insurance systems, which themselves can be complex and often legacy. So a lot of data management and preparation work there before we can do advanced analytics and build traditional machine learning models. In step 5, we really are looking at deploying models into production. And that's to generate all the benefits around automation, customer experience, cost reduction, etc. And this involves integrations with existing processes, existing systems, like rule engines, maybe other systems, to deliver this outcome that you see here. Augmenting it with a predictive model to further uplift automation or improve experience of customers beyond what the existing business as usual process, which is typically a rule engine and manual underwriting. And for those insurers without a rule engine, it would just be manual underwriting. So really this as a strategic roadmap, I think is important for actuaries because it helps us as a guide to understand what data are we talking about, how should we evolve beyond the existing underwriting process to predictive models, how does production actually look when we integrate, and finally, what about GenAI? GenAI has the potential to assist human underwriters in their workflow. And this, as you see here, is particularly relevant for referred cases that cannot be automated by rules or traditional AI. And finally, once in production, we write business, we do in-force management, and we incur claims. And at the claim stage, again, an opportunity arises for GenAI to assist claim assessors. And following this through gives rise to the idea of an actuarial control cycle 2.0. And why 2.0? Many of you will agree that linking claim data with auto underwriting or even just application data is tricky historically for legacy reasons, technology reasons, domain knowledge reasons. But really with advanced analytics, we are able to do this today. So teams that really understand the nuances of rule engine data have that opportunity. And so this gives rise to the actuary, which is usually looking at policy and claim data alone, to now bring underwriting data additionally. And this opens up possibility for new use cases, different predictive models, insights about non-disclosure, improving the profitability of business that is written, and so on. So this is the first concept of a new actuarial control cycle. And from an overall benefits perspective of augmented underwriting, why should an insurer consider that? It is really about the customer experience at the core. And that is because insurers realize their onboarding process is so fundamental to whether customers would apply to that particular insurer. Would they find the onboarding hassle-free? Or will it have friction? Will they drop out of the sale? So this is really fundamental to insurers' development. And then obviously costs can be reduced. From the profitability side, if you can detect non-disclosure, that's an immediate benefit to claim experience. So there are many different levers for value to be created. And this is really why we say that the business as usual process is augmented with AI, and hence the concept of AI-augmented underwriting. Insurers are at different phases of this journey. Some are still at step 1. Most are at step 2. Some have started looking at the data, but are not really sure how to move to step 4 and 5. And so there's a lot of opportunity ahead of the industry. In terms of benefits to be realized, there are different insurer needs. And these are just at a high level, and drilling down one level further, there's quite a wide range of sources of value that different predictive models can deliver. So that's just to be aware that when we talk about automation, that actually is a layered topic. Some is at the point of sale, some is in manual underwriting, some is at claim stage, some is about automation, some is about profitability, or both. And this underwriting 2.0 or augmented underwriting is really an umbrella concept that could address multiple. Most interesting, I'd like to jump to a case study now, focused on straight through processing and underwriting, right? This is underwriting automation. It's a really important KPI for most insurers because it touches the customer. It defines the customer experience. Will they get an instant decision? Will insurance be quick to access? Or the turnaround time be days and weeks? So that's a fundamental customer experience topic for our industry. So this process flow is pretty generic. Most insurers have some kind of rule engine delivering some level of straight-through processing. As you can see here, 27% of cases going through the rule engine are straight-through accepted standard risks. The other 2/3, and this is just to illustrate, are manually underwritten, right? Referred to the back office. And as you can see here, when you link final underwriting decisions that the underwriters have made with the auto underwriting data, you build up an interesting insight across, we've seen it in several countries. Typically 80% of referred cases are finally standard, but not automated. And this is exactly where customers start to drop out of the process and insurers lose opportunity. This is why, predictive models are able to learn from human decisions, and predict them at the point of sale, and thereby avoid a lot of this unnecessary referrals that is delaying the turnaround time, etc. So this is really what we focused on in terms of a problem statement. And we've been able to uplift STP quite considerably. So this is a doable use case. And this is just to give you a before and after sense. Quite a significant uplift in STP. And what I'd like to do now is just to show you a real-time series, which has just been anonymized, just to illustrate some of the core concepts. And what you're seeing here is a time series of a live deployment. All right, the beginning of the time series is when the predictive model was deployed, and a couple of points to call out. So firstly, before predictive model was introduced, you have this dark purple line. This is the STP without the predictive model. And the rules in the audio underwriting engine were automating the case volume shown in dark purple, right? So on the left vertical axis, we've got the count of cases or applications. And on the right axis, we've got a couple of percents, STP, and I'll come to the others. After deploying the predictive model, you can see here in this particular case, a doubling of the STP rate. And you can see here the cases in light purple are the additional cases automated purely by the predictive model, right? So a fairly significant uplift. The orange cases are quite interesting. I'll come to those now, but many people ask, can't we get to an 80 or 90% STP? And it's important to understand in your context that you're operating in, your underwriting philosophy, your company environment, there are natural ceilings. And that gets defined by the underwriting philosophy. So this broken orange line here is the final standard percent of cases. So looking at the final decisions from underwriters, what percent were finally standard or low risk? So if your STP definition is straight through accepted or standard, you're pretty much bound by the final standard percent. You can't really go beyond that based on that STP definition. So it's important to understand when setting expectations on the value from an AI model in underwriting, that there are these natural constraints. And that is why, after deploying the model, you can only get so close to that ceiling. Even though double of the STP rate is great, there is still a gap that remains. And that brings us to the orange cases. This is not automated by rules or the model, but is still landing up standard after an underwriter looks at it. So in production, you have a combination of rules and predictive models doing automated decisioning, and a balance of the cases still being referred for manual underwriting. From a insurer need perspective, just to call out some of them, I think I've touched on most of these. From a benefits perspective, it's really the instant decisions, the growth in sales, and turnaround time improvements, etc. Many insurers are also struggling with under headcount capacity. If new business volumes grow, do you need to employ underwriters? So obviously with a predictive model, if your volumes grow, you can still decision larger volumes of cases. The model is easily scalable to higher volumes. So that's an interesting point, not always spoken about. And then you might wonder, okay, but what are all these other cases? So the orange remains an opportunity for improvement. From an actuarial perspective, this KO or knockout This is what we call a risk guardrail. Some of the cases we don't want to go through a predictive model. They could be really high sums assured, extreme ages, BMIs, high severity, chronic conditions, or disclosures. So the actuary has to understand that there needs to be risk guardrails. And between the actuary and other domain experts, underwriters, you can set those to fit in with your company's risk appetite. So these cases here in pink are actually knocked out. And we say further potential from AI because this particular group, the model does actually predict standard. So if we let them go through the model, we would have further STP gains. It's just that we deemed them too high risk to allow the model to decision them. So you need to understand your risk appetite and set appropriate risk guardrails. The gray cases are not automated by rules or the model, but are finally substandard, loadings, exclusions, declines, etc. So this gives us the total breakdown of cases going through an augmented underwriting system in production. And I hope that this increase is convincing for some. Now, the actuaries for sure would be wondering, but what about the risk implications of this? So I'm going to go into that in a few moments. Before I go into a deeper dive on risk, just to contextualize the solution life cycle, right? And I think this is important for actuaries to be familiar with. Really, from the business problem to building the model, deploying it, maintaining it, there's many steps involved. Ingesting data, preparing it, exploratory analysis, model development, validation, and finally comes the actuary. The actuary is involved before with domain knowledge, but especially in terms of actuarial risk sign-off. So before the deployment of models, it's essential, particularly for high-risk use cases, where there's increased claim potential in future because of model error or high reputational risk, that actuaries do a comprehensive risk assessment. So that's one key role already in the life cycle for the actuary. And obviously AI regulatory compliance is a core topic today. Many mature markets have guidance already from regulators, and you'll be familiar with the topics of bias, fairness, explainability, etc. That would be covered under AI governance. And finally, the insurer takes risk. Once you deploy, the model is live doing decisioning, and your claim experience is at risk, is now a function of the model performance. So risk acceptance and risk management post-deployment clearly are a good domain for actuaries to add value in. So once we are live after deployment, you need to monitor. Models do drift. Their performance isn't static. You need to retrain them with new data over time. There are also changes in underwriting. We call them business as usual changes. And therefore, the model has to adapt to changing business requirements. And some of them can actually impact the model's functioning or performance. So there's an element of being dynamic to consider in maintaining models in production. And even less obvious things like operation support. You're dealing with cloud infrastructure, hosting models, API integrations into insurer systems. SLAs need to be fulfilled when models decision cases at a point of sale. So there's a lot of factors to consider across the life cycle. And actuaries play a key role in optimizing benefit and risk, and in ultimately ensuring there's a business case. But I think it's important to call out that maintaining a business case in production requires model management, adapting to BAU changes, and obviously regulatory compliance. If a model drifts, it may compromise a business case. So actuaries play a key role in post-production or in-force management. I won't spend a lot of time on responsible AI. You can find a lot of this in AI regulations, but I do want to call out the last pillar for actuaries, risk implications. And this is where a translation of data science performance metrics of the model into future claim financial risk implications is where the actuary can get involved. A lot of actuarial methods are required to deal with this. And to illustrate the source of risk, I'm going to use the STP use case as an example. So on the vertical axis, we have different levels of STP, and on the x-axis, different levels of error from the model. So using a typical confusion matrix on the right, we have the model decision, standard or non-standard underwriting outcome, and we have the traditional underwriting or BAU process, where the model predicts standard, but actually an underwriter would have given a non-standard outcome. This is a false positive error. And you can see here the different categories. In the worst case, the underwriter would have declined the case or had an exclusion or a loading. And that leads to a mispricing of risk. And this is really the source of risk in augmented underwriting for actuaries, in that you need to know how to price for the expected increase in future claims as a result of model error. And that requires a lot of domain knowledge, different actuarial methodologies. So false positive rates or slip-through rates, however you define them, the source is, a model error. For example, as I said, predict standard, but should have been a higher risk underwriting outcome. And there are a variety of ways to deal with this. We have various tools, but ultimately you need to understand for the higher STP what the kind of pricing loadings are going to be. Once the model is live in production, you need to know how to maintain it, model retraining, monitoring, etc. And that requires a concept called MLOps. So this is still fairly new to most actuaries, but looking across the life cycle here, these are the typical steps that a model will go through in its life cycle. And MLOps is really, from an IT perspective, using the DevOps principles, it applies them to machine learning. And this is really the right people, processes, and tech to actually maintain the model, to run pipelines in an automated way in production. So the automation of data science workflows is enabled through MLOps principles and technology that fulfills it. And why is this important for actuaries? Because when models deteriorate, you need to retrain them. There's a life cycle. And this MLOps technology enables the actuary to fulfill risk management in production. So before I get on to the other topics, this is really about post-deployment, monitoring, and retraining. If you don't have proper technology to do that rapidly, financial risk could be heightened for longer periods of time. And that's the core domain of an actuary to manage. Going on to another topic now, most of the data science initiatives I've seen talk about exploration or POC. And very few talk about the rest of the iceberg. So what do you need to consider pre-production? So I mentioned actuarial risk sign-off. This is one I think that actuaries really should upskill and get familiar with, where they are supporting AI initiatives, and probably signing of comprehensive risk reports and advising the company on the adequacy of pricing for future risk. But the other topics, the rest of the iceberg, which are all about production, these are not well known. And these are actually critical, not that the actuary has to personally take care of it, but that there need to be processes and technology in the company that does take care of it. There needs to be governance around that. So how do you monitor the risk of a model that it's still performing? How do you track experiments? How do you deal with business as usual changes in underwriting? How do you have data always up to date for model retraining? So all of the topics listed here are really hygiene factors for risk management. And when an actuary is thinking about signing off, it's a good idea to ask what processes and tech will be in place to manage the model, because that determines your profitability on the back of the model. So just to leave you with the iceberg concept, don't over-focus on the exploration stage. Value only comes out of production, and maintaining it requires proper risk management. In case it's not clear yet, why is MLOps needed? Here's an example where a model performance deteriorates. We call it model drift. And there are various reasons for that. If you don't have monitoring tools, as you see illustrated here, you just need to detect there's an adverse trend. Once you've detected, you need to take corrective action. And that could be model retraining. An example data science workflow is shown in the bottom left. And through that, data scientists retrain models with new data to ensure a stable model performance. And that's critical for the actuary because that determines the future claim experience impacts from the model. So, this is really essential and very much linked into the actuarial control cycle of monitoring and refining. This is just a view of what an MLOps platform looks like in a bit more detail in terms of data ingestion, retraining pipelines, monitoring, be it on the model performance, the technology around API, etc., integrations with systems, an insurer system environment. So there's a lot to consider. Operation support to ensure uptime in production. So I call it the risk complexity. There are many factors to balance here and to have process and tech in place. Looking at the future of underwriting now in terms of benefits and risks, this is just a vision to sketch for actuaries. We typically talk about automation, but there are a whole number of other use cases that deal with accuracy. So some of you may have realized that by increasing automation, you just repeat what the underwriter would have done at scale through AI models. But the opportunity to improve the risk assessment, for example, by taking into account the claim experience, that is a different source of value than just replicating the existing underwriting decision. So to take you through a few different machine learning solutions and use cases, I've spoken about STP, but there are a number of others under the bucket of automation or streamlining. For example, waiving medical tests at point of sale, optimizing the application form. And as you move into the middle box on accuracy, the one I would like to call out is using future claim data, linking it with underwriting, and enabling predictive models to predict the future claims, but at the point of sale with a much richer set of variables from underwriting. So most of our pricing that actuaries do is using rating factors from policy data, but underwriting data is much richer. It has medical disclosures and all sorts of other rich elements on the risk profile. So in terms of accuracy, if you can predict the future claims at point of sale, it gives you a deeper lens into the risk than self-declared information from application forms. Similarly, there's a whole range of opportunities on non-disclosure, which manifest differently in different markets around the world, depending on the nature of the products and the underwriting process and the pricing basis. So this middle box is an area for actuaries to consider. Could you actually improve the claim experience by detecting non-disclosure fraud or understanding the claim experience in the underwriting process? The goal being to kind of automate low-hanging fruits, the risks, and the bulk of customers would go through an intelligent triaging process. And this is where GenAI comes in to assist the underwriter with productivity gains, maybe flagging signs of non-disclosure, etc. So the key point here with actuaries is there is a trade-off of automation use cases and cases that improve the accuracy of risk assessment. And they are not always aligned with each other. So that is a trade-off you need to strike in your particular organizations. But I do think that is a bit of the holy grail for actuaries in terms of how to achieve it. Different predictive models might enable that. I'd like to highlight how risk complexity can grow as you deploy different models into production. So imagine you deploy one model, you have the life cycle I showed earlier on, and the iceberg of all the complexities. As time goes on, you build further use cases and a second model is deployed, a third model, and so on. And eventually, you'll end up cross-sectionally with a lot of complexity to manage across different models. And this is why MLOps and a deep understanding of model management practices in production is essential to managing this at scale, such that the risk implications for future profitability and claims and sustaining the business benefits for the stakeholders is possible. So I think this is just important as insurers embark on different models and use cases, that you understand how risk complexity can grow and multiply. And without the process, the tech, domain expertise, it may be tricky to handle. So just something to bear in mind as you move beyond the POC to real deployments. And finally, in terms of how does GenAI and traditional AI fit together in underwriting, you can see step number 2. I've spoken about augmented underwriting today, where traditional predictive underwriting models can be integrated with rule engines to drive further STP. Other use cases are possible, as I alluded to. For more complex cases that cannot be automated, by rules or traditional AI, do you have the opportunity for GenAI to assist the underwriter downstream in the process? And here we are talking about OCR for extraction, large language models for summarization, helping the underwriter to process long medical documents efficiently. We refer to this as the last mile of underwriting. So these are just some of the dots for consideration to join up as we go forward. I showed you the strategic roadmap in the beginning, moving from rules to traditional AI to GenAI. And this is just food for thought. I would just say about GenAI that it tends to be the label that we use, but GenAI-based co-pilots or assistants have many other technologies, such as OCR, knowledge graphs, and you need to understand the limits of OCR, how to manage their errors when using them, and how to really understand what they mean for financial risk at the end. But as said in the beginning, these are really human-in-the-loop solutions. So there's assistance to the final human decision, as opposed to automation in step 2. And because of that, the risk does have a different nature, but still, you need to have proper frameworks in place to deal with the limitations of LLMs. And with that, John, I hope I've made up some time to leave some minutes for Q&A.
You have done very well, Lee, catching up with time and finishing sharp at 45 minutes. So thank you so much, Lee, for the very insightful presentation. For me, and I'm sure for many of us on the line, it's great to see how this could work, not only in theory, but also in practice, and also, to learn of the many opportunities it presents for actuaries. Right, so let's move on to the Q&A session now. As a reminder to the audience on the line, if you haven't already, please type your questions into the Q&A box at the bottom of your Zoom window. We try to get through as many as we can. Right, so let's start with the first question. This question is on non-disclosure. It's a two-part question, Lee. So this is from Lars. He is keen to understand how the issue of non-disclosure is managed at claim situation. How to re-underwrite a risk when a claim occurs at a later stage. So that's the first part. The second part, how would the application be underwritten at application if the non-disclosed information had been available at application?
Okay, maybe just for chronology's sake, I'll start with the second one. At the point of sale in underwriting, I think it's the information that isn't disclosed, it isn't disclosed. So I think it's really about flagging the case. Can you detect that there's potential for anti-selection or non-disclosure before risk acceptance and claims emerge? So that whole space of solutions is to do with things like predictive models that can flag the customer may be a higher risk of early claim, for example, and then you can act accordingly on that insight. Then moving down the policy lifecycle to claims, the claim is now emerged. I mean, yes, of course, it's always tricky in terms of remedial or repudiation action at claim stage. There's reputation of insurers and obligations to the policyholder in many factors to consider. But I think it really starts by having a view on non-disclosure risk at point of sale. If you already knew this case was high risk, that's already an insight available at claim stage. There's also possibility for predictive models to apply at claim stage, based on all information gathered on the customer from underwriting and claims. And that's also where traditional AI and GenAI fits in, because you can start to compare a lot of unstructured data as part of claim submission to what was disclosed, to policy conditions, exclusions, etc. And you can start to flag anomalies. So, I think that's the stage. But in terms of how do you re-underwrite the case, I mean, that's a much more complex topic. My contribution today is really the science to detect that there may be non-disclosure, to enable proactive action at point of sale. And then at claim stage, can you flag that may have happened, such that the claim assessor can act accordingly. But I think it's going to be a process per company how they want to act on that insight.
Thank you. let's move to the second question on ML ops. So this is the question, Lee. How did you manage the model drifting, and how often do you retrain your models?
So model drift, as said, first step is, can you detect it? So has an adverse trend arisen? And for that, you need proper monitoring tools with proper data pipelines, such that you can have sufficiently frequent monitoring, right? And monitoring of what, of course, firstly, of the business KPIs, what was the model meant to deliver? Second, of the data science performance. And thirdly, things like mix of business from a domain knowledge. You need to be able to monitor relevant trends and metrics to the use case. And then once a trend is there, you need to act on it. And as said, the model retraining pipelines through MLOps is fundamental. So the data science workflow to retrain a model, that pipeline, executing it rapidly and reliably is essential. If you can't do that, it means that drift is going to be prolonged along with the financial risk. So there's a whole technology discussion we could have, but trying to keep it generic, you need proper monitoring tools, you need data pipelines, you need technology to execute model training pipelines for data science retraining. You need technology to redeploy the model into production, and to continue monitoring it. So, there's many layers to that, that time is limited today, but there are a lot of different technologies out there. Insurers will be constrained by their own organizational choices. For example, Azure infrastructure, AWS, there's different tech stacks, that underlying all of that are the principles of MLOps. So, that's the place to start.
And you mentioned deployment, Lee, and that's the nice segue to the next question. What challenges do you foresee in deploying the model, and how much testing will be required before it's production ready? So that's the first part. I'll maybe let you answer the first part before. There's a second part to this question as well.
Okay, right. I think core thing is risk management should be in proportion to the risk, and that, I think, is about the use case risk materiality. So if you have a model flagging non-disclosure that an underwriter then looks at and acts accordingly to do due diligence, that's not posing an increased risk of future claims. You can only strengthen risk assessment. If you have a use case like I showed on STP, where you increase automation through auto decisioning via predictive model, clearly the error from that model has risk implications for future claims. So, the approaches to these two are quite different. But basically the risk quantification is the first step. As I showed earlier, before production, you need an actual method to quantify the risk. What does the model error mean for future financial claim risk? Then you need methods to minimize that pre-production, facilitate actuarial sign-off, and then post-production, you need an active in-force management. So monitoring and retraining of models, the whole MLOps, that is what's going to enable you to manage risk in production. And I should also say, it's not just financial, also regulatory and reputational. So regulatory frameworks are here. You need to start to monitor bias, fairness, etc. in production. It's not just a pre-production topic. So consider those factors in the context of your use case and the risk materiality, that it is in proportion to the risk.
And the second part of the question, as more data becomes available, how much would that improve the model's credibility? And how confident are you in its current state?
I think it really depends on the type of data we're talking about. If it's just more volume of the same data the model was trained on, there is a diminishing returns of adding higher volumes of data. If it's a different source of data that you are introducing, that clearly depends on many aspects of that data. There could be external electronic health data, could be banking data. There are many sources for external data, and each one will have a different level of predictive value. Sometimes it's not the type of data, but also the volume of the new data. If you need to link different data sets, the overlap that you land up with in the end, is it sufficiently credible? This comes in especially with insurance and banking data. The overlap in customer bases it plays a role in the model performance you can achieve based on a given volume. So, and then there's a lot of missing data. If once you look at electronic health data, how complete are the customer's records? How do you deal with missing data? So it's really a Pandora's box in terms of different types of data. It depends on some.
Thank you. Now moving to a different topic. How do you see the acceptance of these models sitting with reinsurers and reinsurance contracts and agreements?
I think generally speaking, what I've covered today is the deployment context is into the insurer's processes to enable the end customer to benefit the better customer experience, so that all stakeholders can actually benefit. So as a reinsurer, typically they are there to enable benefits to the insurer, to enable them to write their business with more automation or with better profitability and risk management. So I think it will vary. You've heard a lot today about the different capabilities you need. So and there's different scenarios that can play out. An insurer could build the model and ask the reinsurer to take risk, and vice versa. The reinsurer can build the model and then also be the reinsurer taking the risk. So I think regardless of the roles, I think there needs to be proper review. And then this word professionalism is the key. As actuaries, I think we have a good track record in professionalizing complex technical risk management work. And therefore, I think there's an opportunity such that when model reviews happen and when risk acceptance happens on the back of a model, that actuaries have brought professionalism to the depth of the review, risk acceptance, and the risk monitoring and management post-production. Those things are going to really determine the outcomes in the end. So I think there's a need to understand what you should consider before going on risk, whether you are a primary insurer or a reinsurer. And I think alignment of interest is worth calling out, John, because developers of models don't all have claim exposure. Primary insurers and reinsurers take risk, and they often share that risk jointly. And therefore, building a model creates an alignment of interest between the two stakeholders. Various other parties that don't have insurance license or risk exposure, they're not exposed to the production results of the model for claims. So I think there's a lot of old points about alignment of interest. I would just say to the reinsurers, if you're taking risk on a model in the primary insurer, be aware of the practices that will manage the model in production. That will impact your claims.
That's very helpful. Thank you. The next question is somehow related, and you might have answered it indirectly. So there's a question around, has this AI being used in distribution, or with insured customers who purchase insurance online?
I mean, the example I showed today is in production in several countries to date on multiple risk types. So I mean, yes, the distribution channels tend to be agents and independent financial advisors or bank assurance. Those are the typical channels, that I've been exposed to. Not so much the direct digital channels. Most of the volumes are typically still coming from agents and a banker, where I've seen it. But it really depends. At the end of the day, if there's a valid business problem to solve and the data is available at the point in time where a model needs to be integrated, things are technically possible. So I think each case has to be looked at, on its own merits.
Agreed, Lee. We have 2 minutes left, and we have two very interesting questions remainingly. So maybe if you could share maybe a 1-minute answer to each, that would be great. So the first one is, can you share your experience of making deployed models explainable for both AI and GenAI within the insurance industry? I think this warrants a webinar by itself, but yeah, over to you, Lee.
Yes, it certainly does. Traditional AI, we have three layers of widely published and understood technical methods. We have global explainability, the features that drive the model overall, and we can make that transparent on machine learning models. We have partial dependencies plots, which is the actual patterns the model has learned per feature in the model. And that allows us as actuaries to check, did the model learn a sensible pattern? Does it make domain sense? The third layer is for the single customer. If you're predicting a single customer, you need to be able to audit and defend this in regulatory frameworks to agents, maybe on the distribution side. And that again allows you to break down the score of the model and attribute the effect of each variable in the model to the prediction or decision from the model. And that gives you transparency at the single customer level. So for those that are familiar, I'm referring to things like SHAP, values local explainability methods. So those three layers, we have now solved this in general for traditional AI. It's not as easy on GenAI, traditional AI. For GenAI, a lot more difficult. The research on explainability is still emerging. And for those that are starting to research on agentic AI, where you have multiple agents in a workflow, I think we need to watch that space with caution and focus on human in the loop processes, recommendations, as opposed to automation. So I think for anything automated, you need to have very robust explainability. The three layers I mentioned. For human assistance with GenAI, you need to be aware of the emerging research on this. So John, I think that's an emerging area, which to my mind has not been fully solved yet.
Thank you, Lee. And in the interest of time, I'm sorry we don't have time to address the last question. Yeah, we'll see what we can do in terms of responding to that. This brings us to the end of the webinar. If you find this session insightful, please share your feedback with IAA. Please keep an eye on the next episode. And the topic is agentic AI. As we bring this to a close, thank you, Lee, for your valuable insights. And thank you all on the line for your time. Thank you for joining us today and enjoy the rest of your day. Thank you.
Thank you, John.